Hey everyone, it's me, EOD here. With interest rates in Singapore falling month after month, is the Singapore savings bond still attractive, still worth it at the 2.x currently that we are getting for this instrument as well? Whether you're a new investor or a very seasoned investor, I'm going to be sharing with you how a Singapore savings bond can form a solid part of your financial portfolio and why you should still understand this product and keep monitoring it, because this forms the basis of every other instrument. Personally, I have recently invested $100,000 Singapore dollars into last month's tranche as well, and I'm going to be sharing with you my thought process of why I do it. This is just for information. Again, I have nothing to sell you in this video at all. It's just for educational purpose for you to understand the better world of finance. So let's start off first with a very easy overview, because I understand not everyone watching this video has been investing in markets like I have for 12 over years. Some of you have a lot smaller and more humble size portfolios. For example, just $500, you can invest in the Singapore savings bond. And this is actually the way I recommend most newbies get into the financial market. If you have never, ever learned anything at all and you want the safest way, great way to start, I wish that I started off from the Singapore savings bond, because it is very good. It's backed by the Singapore government. This is a MAS, Monetary Authority of Singapore issued instrument as well. So it's very, very safe if you trust in the Singapore whole environment. Can start at $500 in $500 multiple, so 1K, 2K, 3K, whatever it is. Interest is not taxable and capital is guaranteed. The only thing you need is to be 18 years and above, have a CDP account and a bank account with DBS, OCBC or UOB, which most people in Singapore probably would have as well. So overview, 3 things that you need to know. Singapore savings bond is backed by Singapore government, so you will always get your investment amount back with no capital loss. This is why I recommend it to new people, because if you are a bit afraid to touch stocks, crypto, gold or whatever not, you're afraid that you lose your money and you might need money urgently, this is very safe because it is backed by a government organization as well. So it's very, very good for people that are a bit more risk adverse, especially those people who are maybe starting out. You don't really want to risk your hard-earned money. This is a solid angle to look at. Next, you can lock in your rates. If it was a really good rate, you can go all the way up to 10 years. Currently in this environment, I don't know how many people will go all the way up to 10 years, but if rates continue to drop to like 1% or like 0.5%, at least you have the option of sitting it out for 10 years to get a pretty decent amount of interest income from this fixed income instrument as well. And last but not least, of course, the third thing that I think is really attractive is, unlike fixed deposits, which you put in the banks or other places, you can withdraw this at any time. So we talked about locking in case interest rates goes down. If interest rate goes up and you lock your fixed D at a really lousy rate, for the Singapore savings bond, you can actually withdraw it the next month and only take in 1 month's interest. So you don't even forfeit your interest at all. You just need to take it out next month and then reinvest it in the subsequent Singapore savings bonds tranche, which is amazing because you can just roll up to the prevailing interest rate. So you do not take in significant interest rate risk, because you can always just take it out, put it into the tranche if interest rates go up as well. So very solid. You can withdraw anytime. You don't get penalty. Fixed deposit, sometimes they don't give you your interest back at all if you prematurely have to take your money out for some urgent needs. Hopefully no emergencies whatsoever. So these 3 things are really, really solid, and why I think it's really attractive as well. But more important than that, if you are an experienced investor, you still need to understand about Singapore savings bond, and you should be keeping track about it. Why is it? It's because Singapore savings bond is your bottom line, which means all money that you do not need in under 1 month, because the liquidity time to liquidate a Singapore savings bond is approximately 1 month. So any money that you do not need within a month should be yielding you at least the Singapore savings bond rate. What this means is I always like to go in and see if this month's rate is 2.2%, all of my investments should at least be yielding me 2.2%. If not, I'm better off just slapping it in the Singapore savings bond. So you don't even need to invest in this. The knowledge and understanding this product helps you already make better financial decisions, because you know what is the bottom line that you're looking at. So how is this done in practice? I have taken 2 screenshots here exactly on the same day. This is for DBS, a local bank, the interest rates for a fixed deposit rate as well. Because we know in 1 year tenure, so which means anything that's 12 months, our minimum is 2.2%. instantly I can highlight those that are really, really trash. For example, you see this 6 month on 2.15. I immediately know that I don't want to highlight this because I might as well just slap it in a Singapore savings bond to get a higher yield. So the only stuff that is giving me a higher yield is from 7 months all the way to 12 months and anything only up to 20,000 with DBS. So anything more than that, they give you a really, really bad rate. And up to 12 months, let's say we take this 12 months here at 2.45% for 20k approximately, we are getting slightly above the Singapore savings bond. So comparing this with DBS, we can actually see what we're exactly getting. 2.45 fixed deposit, slightly higher. The thing that we trade off is a forced lock-in for 12 months, which means your money is guaranteed to be locked up for 12 months. You do not need this money for 12 months. And for this 20,000, you will get in exchange for the forced lock-in, you'll get $50. What if interest rate goes up? You take that risk. If interest rate continues to go down, great. You benefit from it in this decision. But $50, is it worth it? I'll leave the decision to you. More importantly, SSB's existence help you make better financial decisions already, whether you invest in it or not. Now, moving on. 3 things. Why am I using SSB? So I come back to the question why I invested 100,000 at this point of time, even though interest rates are falling nonstop. Number 1, my perception of interest rates right now is that it's going to continue to go downwards. Whether it is going to go down by 1%, whether it's going back down to 0 or whatever not, I'm of a view that there is a falling interest rates. As we mentioned in the 3 parts over here, one of the advantages of doing some sort of fixed income instrument is you lock in the rates. The higher the rate it is now, if it's going down, you actually benefit because interest rates go down, you get a much better rate and you put it in. So that is one of it, but it's not the main thing because you can pretty much get into any other fixed income instrument, fixed deposit, if you believe it's falling interest rate. More importantly than not is why am I not deploying it into markets right now? Is because there is a significant level of uncertainty. For me, I use Singapore savings bond from time to time when I'm trying to park cash, I'm trying to hide from the economic uncertainties around. So this is something that I like to do. You get some clipping, some interest rates. At the same time, you want things to maybe be a bit more certain. I'm watching certain things for stuff to happen before I deploy my cash. And last but not least, of course, is I want liquidity. I do not want to lock my money up for 12 months because if I see this opportunity that is around, you want to be able to deploy it as quickly as possible within like 1 month, once you press the button to request to get your money back, you get it back very quickly. So this is why 3 things why I still use Singapore savings bond, even though the interest rates is very, very low, and it may continue to decrease as well, depending on when you're watching this video, or it could be even higher. But 3 things that even a longer time investor like myself why I would still use a Singapore savings bond personally. And I just deployed 100k Singapore dollars too. So instead of talking about all the bright sides and all the upsides, I want to talk about some downsides as well for us to consider. 1, you have to wait a month to get your money back. As I mentioned like in the part of the video, but it's not exactly a month. So how it is let's say as of time of recording, it's towards the end of May. If I request to get back my money at end of May, I actually get it back in the 2nd business day of June, which could be like 5th June, or whatever, not depending on when the Saturday and Sunday is. It's a business day. So you can get it back like 5th of June or something like that if you request it for like in the end of May. So it's not exactly a full month. It can be even like less than 7 or 10 days, depending how the calendar goes. So not exactly very, very bad. And at the same time, you still get your interest back. Fixed deposit, you request for your money early, you might not get your interest back. But for this, for whatever time you have invested, they will give you that interest as well as your 100% of your capital back, so your money back as well. The catch here is you pay a fee to the local banks to help you process the transaction. I believe it's about $2 as of time of recording. If you're investing small sums like $500 and immediately cashing out the next month, you might take into a negative because of the transaction fees. So that is something to note. But if you're investing like 10,000, 20,000 for a month, 5,000 for a month, generally the interest rates will pay off this transaction fee that you are doing, even if you have to cash out the next month. And of course, last but not least, the third downside is if you hold this for beyond 6 months, the interest rates are only given and paid out every 6 months. For those of you who are relying on this for cash flow to pay your bills and stuff, this could be a downside. There is a way that some people do it, how they hedge out this third downside. And that is through this ladder strategy that some of them like to do. It's an analogy, and it's a bit more confusing when you just know about the analogy. It's very simple to understand. So what it is instead of putting this 100k in one tranche and getting your interest only every 6 months, what you do here is you buy every month for 6 months. You split up your 100k, you divide by 6, and you invest the same amount in every single what we call tranche. So January, I buy a little bit, and that bond will pay out in Jan and July. February, you buy the same amount. March, you buy the same amount. April, you buy the same amount. May, you buy the same amount. June, blah, blah, blah. And you basically get every month, you'll be getting interest. This helps you hedge out your cash flows much nicer. If you rely on this, maybe you have 200k inside and you want the money for paying your bills and stuff. So you don't want it to be every 6 months. The downside, of course, if you buy every month and the interest rate continues to drop, you might have to take an average. Some months you might get less, some months you might get more, depending on how the interest rate environment is going for the next 6 months. That's the only thing you need to take note of. But this is a great strategy for those of you who rely on it for cash flow specifically. Of course, there are some things to note at this point. It is not, you can't put like 1 million inside liquidity. You can't hide 2 million, 3 million for those of you more wealthy people watching this video. One important thing you know is you can only put in up to 200k in this Singapore savings bond. 2% of 200k is about $330 per month, so it's not an insane amount of money, but it's still something for those of you who are using it to maybe pay bills and stuff like that. For most people that are watching this video, a lot of you will be considering CPF ordinary account, and many a times they can offer you a higher interest rate depending, of course, on the interest rate environment. So some people take the CPF OA money and invest it into SSB to improve the yield because you're technically getting a risk-free instrument, putting it in a risk-free instrument and getting a better yield, especially if you do it over long periods of time, especially if you're doing it you don't need it for property, you're not using your CPF a lot, have a lot of excess. Some people actually consider doing that, but that's beyond the scope of this video for now. I'm just specifically talking about it as a cash instrument in a financial portfolio. And of course, last but not least is you may not get your full amount that you want. So they always offer a set amount, and if it's super high in demand, let's say a lot of people are expecting, or they gave a very good rate or expecting interest rate to go down, if a lot of people bid for it, you might not get, if you try to put 200,000 all at once in that month, you might not get it fully allocated. So that is something that you need to take note. They might only give you a partial amount of what you request. So you request 100k, maybe they give you like 20k, depending on how many other people are also taking that tranche for that month. And last but not least, of course, if you guys are a little bit more aggressive at this point, you feel like 2.2% for this year is way too low, you want to go for something more aggressive, do check out this video, which I talk more about stocks and equities, which we cover on the channel as well. If you like the way we present, you want to know more about financial markets, like and subscribe, and check out these 2 other videos, which I think you might like as well. See you guys in the next video.